The COVID-19 pandemic and the turmoil in financial markets has made the past few weeks a challenge for everyone. Like most businesses, we've implemented a pandemic response plan, which means our entire team is now working remotely. But that doesn't mean that things have slowed down. On the contrary, it's full speed ahead. And our team continues to be very active in the markets, finding a lot of value in credit. To talk a little bit more about that, I'm joined by my friend and colleague, Brian Carney, who's a portfolio manager here at Canso Investment Counsel. Brian, good afternoon.
Good afternoon, Jordan. Thanks for having me.
Good to have you. Brian, I wanted to start off by looking at the numbers. We know that as yields fall, prices rise, which might imply that credit would have done well recently. I wonder, is that the case? And if not, how do we reconcile the two?
Not so fast, Jordan. It is true that if yields fall, prices rise. But the reality is, in times of crisis and catastrophe like we've been in, not all parts of the fixed income markets react the same way. And so we've actually seen dramatic sell-offs in both investment grade and high yield credit. So at one point in March, US investment grade credit was down over 10%, US high yield down over 20%. Now, since those lows, there have been a number of announcements by federal governments and central banks that have helped to stabilize the market. And in fact, those markets have recovered somewhat. But all in all, if you were invested in corporate credit, it was a negative month for you.
Brian, let's focus on treasury yields for a moment. In times of crisis, we normally see a flight to quality, which would drive yields down. Is that something we're seeing now?
We have seen that, Jordan. And in periods of crisis, as people are selling equities or selling investment grade high yield bonds or other securities they perceive as having more risk, oftentimes they're buying government bonds, which are perceived as the safest or more risk-free assets. So that supply-demand dynamic has certainly been in play in the US and Canadian government bond markets, where at one point we actually had 30-year government bond yields in both countries well below 1%. Now, what we've seen subsequent to that is a rise in yields, still at very low levels, but as the markets have come to understand that the public policy announcements by both governments and the central banks will lead to significantly increased deficits and more supply of government bonds, the markets have started to realize that sub 1% on 30-year government debt is probably not where they want to be.
Brian, as you mentioned earlier, credit returns were decidedly negative in March. Does that mean that investors should be looking elsewhere, or is there now an opportunity to be had in fixed income?
Jordan, we think there's a real opportunity in the credit portion of the fixed income markets. And we've got a couple of charts which we think highlights this. So if you look at US investment grade spreads, we haven't seen levels like this since the credit crisis. Now, they were a little bit wider in the credit crisis, but if you look back over 20 odd years of history, this is one of the best opportunities there's been. And then if you move to US high yield, again, we haven't seen levels like this since the early days of the credit crisis. So investors need to do their homework because you're lending money to individual companies, so you need to understand the companies you're lending to. But when you look at the markets in aggregate, we think this is an incredible opportunity to be buying corporate debt, with the caveat that you buy corporate debt if you believe that there will be a solution at some point to COVID-19. And we at Canso believe, as dire as the situation has appeared, at some point we will come out of this, and there will be companies that come out of it, and they will be viable. And those are the types of companies that you want to lend to. We think it's an extraordinary opportunity. And, investors, there will be opportunities in other markets, but certainly the credit markets are worth a look.
That's good information, Brian, and that's it for me. So thank you for your time.
Thank you, Jordan. Be safe.
For more information, please visit cansofunds.com and check out the April Market Observer.